Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Celestica Q4 Preview addressing Google Cloud rumors, rating upgrade. This article was written by Uttam Day. Summary. Pause. Celestica is upgraded to bullish ahead of Q4 CY25 earnings, driven by robust AI networking demand and hyperscaler CapEx strength. CLS is projected to deliver 27% revenue growth in CY25 and 31% in CY26, with management consistently raising guidance and outperforming initial projections. Despite recent speculation about Google Cloud shifting server assembly orders, I expect management to reaffirm strong client relationships and clarify sustained program status. CLS trades at 35 times CY26 earnings, with EPS expected to grow approximately 40% to $8.2 share. Insider selling remains minimal, supporting a constructive outlook. Investment thesis. Celestica, CLS, is set to deliver its Q4 CY25 earnings results next Thursday, January 29, before markets open. This Canadian AI networking company usually stays out of the spotlight, focused on delivering networking and connectivity solutions to its hyperscaler customers. The reality is that Celestica has been in absolute beast mode, with revenues expected to grow 27% this year and accelerate 31% next year. The company's hyperscaler customers appear to be satisfied with the company allocating an increasing amount of CapEx dollars towards Celestica's switches and server assembly solutions. That is until this report that was published yesterday, speculating a top hyperscaler client may be moving its server assembly orders elsewhere. I expect Celestica to confidently address these rumors about its top hyperscaler client next week, and believe the company is well positioned to benefit from another year of strong hyperscaler CapEx deployments. I am upgrading Celestica's shares to a bullish view ahead of the Q4 ER next week. Restore investor confidence. It has been a while since I covered Celestica on this platform. In June last year, I downgraded Celestica's shares to a neutral view after I told investors that I would be trimming a small portion of my shares. Celestica's shares had aggressively appreciated since last year's April bottom, and that pushed me to trim some of my shares at the time. But Celestica's shares have surged 2x since my coverage last June, as its top hyperscaler customers continued to pour their respective CapEx dollars into Celestica's HPC switching and server assembly solutions. The company's performance has obviously superseded my neutral view that I issued last year, and that's purely because of the marvel in how well run this company is. Here's a chart that I made to frame management's initial projections for the following year's revenue growth guide versus the actual revenue growth that Celestica ended up demonstrating. Note that CY25 and CY26 revenue growth rates are based on management's projections announced in the Q3 ER and 2025 Investor Day, respectively. As can be seen above, there usually is a wide gap between what Celestica's management projects in the first guide for the following year versus the actual revenue growth that Celestica eventually ends up delivering. As the year progresses, management usually keeps raising their projections, which I have not captured in this chart. But the delta between the initial guide and actual revenue growth signals the strength in Celestica's networking business, which so far has shown no signs of stopping. I'll frame the perspective in the paragraph above in a different way. Revenue growth has only accelerated every year, with the company well on track to deliver $12.2 billion in CY25 revenue, per management's projections, implying 27% growth, accelerating from CY24's revenue growth of 21%. That kind of revenue growth and that kind of revenue acceleration has resulted in Celestica winning meaningful market share in the data center switch market. This just shows how well-positioned Celestica is in serving demand for its data center switch business, the strength of the company's relationships with its key hyperscaler customers, and the robustness of the company's products and solutions. That's also reflected in the company's product inventory levels, where the company is holding inventory for just 65 days. That's how quickly Celestica is turning its inventory into product revenue. In the 2025 Investor Day, Celestica's management raised their CY26 projections well above expectations. CY26 revenue projections eventually landed at approximately $16 billion, well above prior expectations of $13.6 billion. Operating margin guidance has also been beefed up by 40 BP to 7.8% from 7.4% in CY25. Why does all this context framing matter for Celestica's investors? Because of yesterday's report that speculated that Alphabet's Google Cloud, one of Celestica's largest hyperscaler customers, was looking at moving some of its server assembly business away from Celestica, possibly towards the Taiwanese ODM company Inventec. Firstly, I am apprehensive about placing trust in the report purely due to the timing of the report before Celestica's next week. Secondly, the report does not fully state whether it is an existing batch of purchase orders that are being moved over to Inventec, or if it is a portion of Google Cloud's 2026-27 purchase orders for TPU-based server assembly that is being shared between Celestica, Inventec, or other vendors. This isn't the first time this kind of speculation has surfaced. In Q2 last year, Celestica's management had to correct an analyst who speculated that the company may have lost a little bit of server market share last year. In that call, management reiterated that in reality, the company was gaining share with their largest customers, and that the company would benefit from significant momentum as these server programs would begin ramping up from Q3 25. In the Q3 call, management reiterated the strength in the business, supported by a sustained ramp in program wins, which I believe gave Celestica's management enough conviction to not only raise revenue growth targets, implying 31% growth this year, but also expect strong growth in free cash to approximately $500 million. Therefore, I fully expect management to reiterate their strength in the switching and server business while hashing out details around program wins regarding Google Cloud in the wake of this speculative report pertaining to possible server market share loss. Outside of the clarifications that I expect management to provide regarding Google Cloud-related customer backlog, I am particularly interested in understanding the strength of their 1.6 TB networking program solutions. The networking industry should see growth in 800G networking solutions mature, while 1.6 trillion B solutions start to ramp up, representing the next phase of networking growth. Plus, Ethernet is enjoying the best phase of its revolutionary moment in the post-ChatGPT era, and scale-up networks are at a critical juncture of transitioning over towards Ethernet adoption and scale-up. These two developments represent robust target opportunities for Celestica, and I'm very curious about just how well-positioned the company is. Valuations might be slightly rich. Heading into earnings, investors might view Celestica's valuation multiples as marginal/moderately rich. The company's shares trade at 52 times CY25 earnings or 35 times CY26 earnings. Focus on CY25's earnings that are expected to now grow 53% to $5.93 versus 24% at the start of last year. Part of the reason was because Celestica was able to revise up its revenue growth rates through CY25 as demand for its networking solutions. The other reason for superior earnings growth rates was due to strong margin expansion that led to significant earnings revisions, leading to the 53% growth in EPS that Celestica is now expecting in CY25. I believe this combination of strong demand and superior execution by management will lead to another strong year for Celestica, which currently trades at 35 times CY26 earnings and is expected to grow approximately 40% to $8.20 per share. In my view, the current CY26 earnings multiple reflects appropriate entry points for investors once again, after the company's valuation multiple looked foamy in Q4 last year. Risks and what to know ahead of Q4 ER. The big risk here is if Celestica's management actually ends up acknowledging the speculative nature of the report regarding Google Cloud's server assembly program. I believe this could be tied to Google attempting to significantly increase its own DC capacity. At a recent all-hands meeting, Google's execs revealed that they plan to double AI serving capacity every 6 months. Google may be roping in additional vendors too to serve the search giant's aggressive timeline of adding DC capacity, in my view. At a macro level, the larger risk is if AI demand starts to slow, which would push hyperscalers to push out their CapEx deployment timelines, impacting vendors like Celestica. What I will be watching in next week's ER is if management raises its CY26 projection.
Hey viewers, like and subscribe to our channel. We'll keep bringing you more insightful stock analysis. It's going to be wild.